Well, after two negative sessions, the equities market closed on a positive note yesterday. Investors gained 35.52 billion naira. But we'll leave the figures for later when Will comes to bring us up to date. For now, we have Jolomi Odonganro, the head of research and strategy at Kodra Securities Limited. He's here to give us an overview of not just the equities, but other related issues. Hello, Jolomi. Thank you so much for joining us. Good morning. Can you hear me, Jolomi?
Yeah, good morning. Thank you for having me.
All right. So activity level in the local bourse has been abysmal for a while. Last month, trading ended largely in the red. With this return of the bull, do you think this will be sustained in this month of June?
If you're looking at the level of activity in the market, I mean, it helps to look at the market dynamics at the moment. Looking at what domestic investors and foreign investors are doing. For domestic investors, given the weak macroeconomic environment and obviously the impact that will have on corporate profit expansion and by extension, the performance of equities, it's not surprising that these investors are very willing to stay in the fixed income market, taking yields about 14% in the bond market. And even looking at bank deposits, we have bank deposits around 13 to 15% right now. That's based on our own market survey. So it's not surprising that domestic investors aren't playing. And for foreign investors, the extent of the participation that we've seen in the market for foreign investors so far, the larger part of it has been reinvestment of dividends as they've been unable to repatriate their funds given the dollar liquidity issues that we've had in the year so far. So looking at the dynamics both between domestic and foreign investors, it looks like we may have weak trading sessions for a while still.
All right, how do you see the market closing today?
So yesterday was a positive. Obviously, bargain buying on Dangote Cement pushed the market upwards. I think right now, month to date is about 0.1% after the 0.2% gain yesterday. Like I said, right now, the negatives far outweigh the positives, and that will be the overarching theme, we believe, for the month, even if we may see pockets of gains here and there. So overall, we're still looking at a negative market performance through the month, although we expect it to be a little bit better than what we saw, minus 4% month gain for May. We do expect a negative performance, however, for the month of June as well.
All right, so fixed income yields have maintained an uptrend since the beginning of the year. When do we expect yields to reach a resistance level, or do you think yields will just keep on going higher and higher?
We think that we've reached that level, actually. If you remember, at the long end of the curve, yields were around 14.25%. This was about 2 to 3 weeks back. And ever since, we've not really seen a lot of movement thereafter. And there are a couple of factors behind this. Number one, we believe is most important, is that the DMO allowed yields to trend upwards, given the government wanted to securitize the ways and means balances. And I mentioned on the show before that looking at the cost to the government of the ways and means balance, it didn't make a lot of sense for DMO to allow yields to trend significantly above the cost of the government, which is MPR plus 300 basis points. And that was the resistance level that we saw, around 14.25%. Right now, yields are coming downwards. At the long end yesterday, we saw yields about 13.7%, already reflecting that we may have reached that resistance level. That being said, the month of June is a very, very tight liquidity month. We have almost no bond coupons and just a few treasury bills maturities, which will likely be rolled over. So given that tight liquidity situation, we may see yields trend upwards again, maybe towards that resistance point, but we do not see significantly or moving past the level that we've seen recently, which is 14.25% at the long end of the curve.
Well, the federal government has been quite active in the market, and they've raised 46% of their domestic quota for borrowing. Do we expect them to remain as active in the second half of the year, considering that the expectation of about $6 billion in foreign borrowings?
I mean, looking at, so the $6 billion on the one hand will completely take away the external borrowing projection was 2.34 trillion that the government wanted to borrow, as stated in the budget. So the external borrowing leg is gone. So what you have left is the domestic borrowing leg. So looking at what is left in the domestic borrowing leg, without accounting for the possibility of the government enacting the plan to borrow from dormant account balances as well as unclaimed dividend, that puts you at about a 180 billion naira run rate through the rest of the year for domestic borrowings. That's after accounting for the bond borrowing so far in the year, as well as excess borrowings in the treasury bills market. So looking at that, that's about 180 billion. The average for this year is around 200 billion. So you're still looking at a significant borrowing schedule for the rest of the year. However, if you have a point where the government does enact this plan, as well as excess borrowings in the Eurobond markets or external borrowings, then that significantly reduces what you expect in the domestic market, which, on the other hand, will now cause yields to start to decline, given the supply and demand imbalance that would present therein.
All right, on the FX loans, now what is the status of the Eurobond issuance and the multilateral loans?
So, as you know, the president has pushed it to the Senate to approve that borrowing plan. Yes, it was in the budget for the year. However, the Finance Act 2020 does require the government to then seek approval for those external borrowings. So we're looking at some point through the rest of the month, we'll see that happen. And from that point, it could be a very, very quick transition of movement from book building to actual issuance of debt. And looking at Ghana, that pretty much did this in a very, very sharp 2-week period. It could be very, very quick from approval by the Senate to actual borrowing, especially from the Eurobond leg, given how quick that market can be. So we do expect most of the borrowings to be done by the end of this month or the beginning of July.
Well, the turnover at the INE hit a year high of $472 million last week. What factor or what drove this?
I mean, looking at the fact that the largest supply in our market is the central bank, and the fact that the government is, I mean, a lot of these things are tied in. The government is now looking to borrow $6.1 billion. You can understand why the central bank may be more comfortable with now reducing the latent demand in the market. At one point, this was about $2 billion. And very recently, they've been extending about $25 million weekly, and now to this large movement in the market. And that is also tied into the equities market performance, because if foreign investors can now come out of the market and see more liquidity to come out of the market, that may exert pressure on the equities market. So overall, what you're seeing now is the government being able, or the central bank having now seeing that it has the capacity to now reduce some of the latent demand and increase the dollar liquidity in the overall market.
Outlook for the Naira, going forward, like short term?
I mean, over the short term, there are significant pressure points, undoubtedly. However, we are of the view here that we will not see a significant movement in the overall INE window rates towards the end of the year. We are still looking at a rate of around 450 Naira per dollar by year end. That being said, the pressure points right now are quite significant, and you can see that in the parallel market above all, where rates are closer to 500 Naira now. That is on US dollars now.
And was the adoption of this Nafex rate as a new official rate signal to the market? When can we expect that the parallel market and the Nafex rates will unify?
I mean, the unification of it's still a long way away. We have a lot of structural issues to deal with in Nigeria to get to the point where both markets are not so far away. Structural issues that obviously take care of US dollar liquidity, and I mean these are issues that we've been talking about for years, and they need to be very, very measured plans that get us towards that point. But for now, looking at the adoption of the INE or the Nafex rate, it's a positive in that investors or foreign investors see it as a more market reflective rate as opposed to the interbank rate that is usually touted, which is around 379 on the official rate. So the Nafex rate is supposed to, or Nafex fixing is supposed to be a more market-reflective rate. And so the adoption of that rate by the CBN is positive, not only for Nigeria's finances, but for foreign perception about the currency. And so it's positive. However, in regards to unification, we are not yet at the point where we're going to see a sustained unification or a close merging of the rates between the now official and the INE and the parallel market rates. There will be pressure points that will come from time to time that will cause a divergence of those rates as long as the overall structure of the economy remains as is.
All right, so with all of this, INE and Nafex, do we see it solving some of the issues, you know, with the access to foreign exchange, manufacturers are complaining and all that? You see it solving the problem, even if it's in a small degree?
I mean, it's a definite positive, undoubtedly. The idea or the major positive that will come from this is that you start to see a lot more foreign participation, foreign inflows, given that they believe the market is more market reflective. And once those kind of flows start to happen, then you start to see obviously greater supply for the domestic leg. But however, for now, you're still going to have the CBN having to be the major supplier in that market, especially with the perception that foreign investors have of Nigeria at the moment. I mean, given some of our own conversations, a lot of foreign investors are not happy about the fact that in the space of 5 years, they've been locked into the Nigerian market twice due to significant dollar liquidity. And so you're not going to see a significant drive from foreign investors coming to this market until there's a sustained level of liquidity in the FX market and confidence that it can sustain over a long period. So it will be positive over the long term or medium to long term, but for now, we may not see those gains immediately.
All right. Thank you so much for sharing your thoughts with us this morning on Business Morning. Jolomi Odohanro is the Head of Research and Strategy at Quadra Securities Limited. Thank you so much, Mr. Odohanro.